Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. Today we are going to start Chapter 8, which will talk about long-term assets including PP&E, intangibles. Let's get started. The key learning objectives for Chapter 8 for this course are threefold. First of all, we are going to discuss what are long-term assets, right? What are fixed assets? And then we're going to talk about depreciation of those assets using a straight line method. And we will also analyze the disposal of the assets and equipments, but the first two objectives are the main objectives for this chapter. In this video, we will discuss accounting for PP&E. What are long-lived assets, or what are fixed assets? There are two types of fixed assets. The first type has physical substance such as land, buildings, fixtures, natural resources. Those can be touched or seen, and they have physical forms. Another type, they don't have physical forms. For example, trademarks, licenses, copyrights, goodwill, patents. Here is an example of FedEx Corporation's balance sheet. You will see on the balance sheet, FedEx reports property and equipment at cost, which listed different types of equipment they have. And those are assets with physical forms or tangible assets. They also report something intangible like the goodwill. So how do we measure the cost of a machine, right, or a fixed asset? The idea is that you include all reasonable and necessary expenditures made in acquiring and preparing an asset for use. So for example, you have a van, and the purchase price of the van, sales tax of the van, legal fees, inspections, transportations, installations, and everything, before the van is ready for use, are counted as the cost of the van. If something happened after the van is in use, that cost cannot be included in the van cost. It has to be counted as an expense. So for example, you have a van, right? You purchase a second-hand van. Now, the invoice price of the van is $10,000, and you fix the van before the van can be used because it has some small problems. So the $1,000 you send the van to the garage and fix that will be included in the cost of the van, so it makes your van's cost $11,000, which is a huge amount that you will depreciate or you will use up in the future, say 5 years. But after the van is in use, you fix it again. There are some small problems. The next day you put it on the road, you find out some other problems. Now you fix it again. You spend $500. Although it's only like a day apart from yesterday you fix it, this $500 cannot be counted or included in the cost of the van and to be depreciated in the future. This $500 needs to be counted as expenses. Now remember matching principle. Because you already make the van in use, you have put the van into use. So anything happens after it's in use, which means you started to generate revenue, then any cost related to that needs to be recorded as an expense. Now, this is an important difference in accounting because the first fixed price, the cost of fixing your van, $1,000, happened before the van is in use, would be what we call capitalized, okay? Capitalized means it's included in the fixed assets. That's called capitalized. Rather, if the fixing happens after it's in use, it will be counted as an expense, not capitalized. All right, so here is an example. FedEx acquired a new aircraft for transportation. That's 26, I believe, say million, right? I don't know. It didn't say what unit it is, but let's still assume it's in million. So the aircraft is worth $26 million, and FedEx signed a notes payable to purchase the aircraft. So the credit side would be the notes payable. If we increase an asset, we also increase the liability. And FedEx also pay cash for the transportation and preparation costs. Now remember, whatever we pay before the asset is in use would be capitalized. So the $1 million would be capitalized and counted as the aircraft. So 1 million plus the 25 million notes payable equals to the asset value $26 million. Now what if we didn't purchase the asset? We built the asset, right? It could be that we built a building. So if we acquire an asset by construction, the asset cost will include all materials and labor traceable to the construction. So if you hire someone to build a building, the wage and any cost related to the construction will be counted as the cost of the building. And if you have some overhead, means some common expenses among different projects, right? If you have 3 different buildings, you have to assign and you use the same machine. You have to split the cost of the machine in certain ways so that the portion that helps to build this building would be included in the cost of the building. And also, if you borrow money to construct the building, any interest for that loan incurred during the construction, okay? If it's after the construction, it's not included. So if you have a loan, say 10-year loan, but you only build the building for 5 years, although you borrow that loan for the building, because your construction time is only 5 years, so only 5 years of interest of that particular loan will be counted as the cost of the building. So here is an example. FedEx constructed a new hangar. They paid $8 million in labor, $11 million in supplies and materials. They also paid $1 million in interest expense during the year related to the construction project. So all these meets what we just discussed. So all of those would be added up to be the cost of the hangar, which we called capitalized expenditures. So if you add these number up, 8 plus 11 plus 1, that's 20 million. You will debit the facilities for 20 million, you credit cash for 20 million. So the facility refers to the hangar that would be depreciated in the future. We will talk about depreciation in the next videos or so. I just want to plant the seed that this 20 million is not an expense. When we say capitalized, it means it's a long-term asset that we are going to use up in more than 1 year. So we are going to allocate the cost of the usage across those years, and we have different assumptions for it, which we will introduce in the future. All right. Finally, after we put the asset into use, as we mentioned, you may have repairs, maintenance, and all sorts of different costs related to that piece of assets, right? So if we think about those different costs related to the asset, as I mentioned in the van example, if you fix the van, that's like ordinary repairs and maintenance. It doesn't increase the productivity of your van. It's recurring in the nature. It's very small in amounts and does not increase the productivity or efficiency or capacity, those type of things. You can't capitalize. They are expensed right away. They are counted as expenses right away. But if you have used the van for a while, but then you change the function of the van in some way, it increases the productivity of your van or improve the efficiency and everything. It occurs infrequently, involves very large amount of money, then those type of things we call improvement, they have to be capitalized. So they are not expenses. They will be added to the asset account. So the only type of expenditures you are allowed to add to your asset would be the improvements, okay? It has to be very large in amount. It has to change your function of your assets in some ways. All right. In the next example, FedEx spent $300 million to modify the cargo area, right? And resulting in 9% greater fuel efficiency and lower operating cost. Now, this is an improvement because it changes the function of that cargo area. In that example, we would need to add the $300 million to the assets itself. So this is a capitalization of the expenditure. All right, in summary, in this video, we talked about what are long-term assets and how to measure the cost of long-term assets. If you purchase the long-term asset, it's the purchase and preparation cost. If you construct an asset, it's the construction cost, the overhead, and the interest happened during the construction. We also talk about improvement versus maintenance, right? If you have maintenance, it's expensed right away, and if you have improvement, it's capitalized. Now, you should watch the McGraw-Hill guided help video 8-1. It talked about how to calculate the cost of the PP&E. I'll see you in the next video.